Joining me now is Ahmed Riesgo, Chief Investment Officer at Insigneo. Ahmed, great to have you here with us.
Great to be here.
Ahmed, let's start with big tech because Meta and Microsoft are both powering higher after earnings. You look at those reports, you look at those growth rates, and you think what?
I think you definitely want to own them. I think in the future, despite the moves we're having today, I think in the future, they're going to look a lot more like utilities and defensive positions in your portfolio. So I don't think you're going to get the growth going forward from these names, but you definitely want to own them. They're fine companies. They're growing, earnings way above the median stock in the S&P 500. So you definitely want to have a good, healthy position of many of these big tech names.
Do you want to buy them at these levels, though? Should note that Microsoft just crossed $4 trillion in valuation. Are you a believer in the AI rally at this point and that there's still room to run, even if the growth rates aren't as impressive?
Yeah, so I don't think, you're starting to hear like bubble territory talk. I don't think we're anywhere near there yet. And like I said, you definitely want to own these names. Now, do you want to chase them for growth? I think that's the difference here. I think you want to have them as ballast in your portfolio to hold them more as defensive positions, but I don't think the growth in the future is going to come from these names. Remember at this point, these are high capex companies. They're going to look a lot more like airline companies in the future than right now. And what I mean by that is that they're largely indistinguishable from one another, right? Anthropic, although that's not a public name, but Meta, Gemini models, it's sort of United and Delta, right? It's sort of a preference. But you're going to have them. They're indispensable. That's why I'm saying you definitely want them in your portfolios, but you don't want them for growth. You want them for defensive posturing.
Are there any Mag 7 names that you wouldn't want to own, Ahmed?
Well, I don't want to get into specific ones right now, but I would say away from the hyperscalers. So let's leave it at that. So away from the hyperscalers, I would tend to sort of stick away because there you could potentially be looking at more sort of binary outcomes, right? And we all can probably guess which stocks I'm talking about.
All right, we also have Figma debuting on the New York Stock Exchange today. It was a highly anticipated IPO. What does that tell you about investor appetite right now? Do you think markets are ready to take on more risk again?
I actually do. I think we're actually set up for a perfectly sort of classic paradigm pain trade to the upside. And what do I mean by that? I mean, this is a very unloved rally. Everyone is very skeptical about it. Everyone is saying it's too quick, right? Too quick of a rally. Everyone's talking about the sort of economic impacts from the tariffs. They haven't been felt. The inflationary impacts, they haven't been felt. There's $7.5 trillion sitting in money markets. So you literally have the perfect ingredients for a pain trade to the upside for that FOMO trade to really kind of kick in.
How much upside is there to this so-called pain trade?
So look, I think a lot of this is going to depend on what the Fed does. I think if the Fed does what it should do, which is, cut rates, I still expect the Fed to cut at least, two or three times this year, despite what Powell said yesterday, because I do think there is weakness in the labor market, and we can talk about that in a second. But I think if the Fed starts to cut soon and cuts at every meeting for the next several meetings, I think you could see the S&P 500, grind up all the way to 7,000. I think if they don't, which is what's likely to happen, which is that they're probably going to be too late, right? This is what the Fed does. They sort of overstay their welcome. Then you could see a much more muted rally, but still somewhere between 65 to 6,700 on the S&P.
Okay, because I was taking a look at the CME FedWatch tool, and it looks like 60% chance that the Fed could stay on hold once again in September now. Obviously, that could change. We know that the president isn't very happy with Powell, given some of his choice words about the decision to stay on hold. But at the same time, we did see PCE come in slightly hotter than expected. So you think that the data justifies cuts on the inflation side?
Yeah, so in our view, the Fed should have probably been cutting back in June. And let me explain to you why. The broader disinflationary trend is in place. Housing, wages, they're all going down. Are we going to see a temporary spike? And I know that's a very loaded word in this, given recent history with the Fed. But are we going to see a temporary spike in inflation due to the tariffs? Absolutely. It'll probably peak 6 months from now. And then by 12 months, you won't even see it in the inflation data anymore. But those are classic, that's a classic transitory spike that the Fed would normally completely ignore as far as setting their monetary policy. However, because the president has been putting so much public pressure on the central bank governor, sorry, on the chairman to cut rates, he's actually working against himself because I think it's make it less likely that Powell actually cuts rate. And I think what you're seeing is a sort of institutional leaning into the fact like, hey, we are independent. We're not going to bend to your will. We're going to do what we think is right. Unfortunately, actually, I think that's a mistake because they should have already started to cut rates.
Ahmed, how much could even a one-time shock in terms of higher prices spook the market, given the fact that it's near all-time highs right now? It doesn't seem too phased by that tariff deadline that's fast approaching. It's tomorrow. Do you think that it could be setting itself up for a fall, though, if we do see those price shocks?
Yeah, look, obviously there's not a lot of room for error if we were to get a price shock. But again, a price shock is different than inflation, right? And this is what everyone has to come to terms with. Tariffs don't increase inflation. They will cause an increase in the inflation data temporarily as a mathematical function. But inflation is the systemic, consistent rise of prices and increase in the money supply. Tariffs do not cause inflation in the longer term.
So even if the Fed doesn't cut rates 2 to 3 times like you were calling for, it still seems like you think that this is a market that's moving higher, maybe just not as much. So talk to me about the areas of the market that have the most room to run from this point.
Yeah, so we still like quite a bit, the defense sector. We like utilities. We think healthcare has sort of underperformed the market. We think as soon as the tariff overhang over the healthcare center gets lifted, we think that's going to be a sector that's really going to rally because I think there's two sectors really that are going to be the primary beneficiaries of all this capex spending that the hyperscalers are doing on AI, and it's the financial sector and the healthcare sector. The financials have benefited already. They have outperformed. The healthcare sector, in my view, has not because of the pharma tariff threat overhang. I think as soon as that gets lifted, I think the sector will gravitate higher.
So what's your best advice for investors right now?
The our constant advice is that try not to time the market. Timing the market is a foolish game. It's impossible to say near-term peaks and valleys. It's impossible to call them out. Usually when people get them right, it's just happened by chance. They think they're good at it and then they get burned down the line. Just, find good companies, solid sectors that you want to invest in and stay invested.
We'll leave it there. Ahmed Riesgo, Chief Investment Officer at Insigneo. Thank you so much.
Thank you.